Heard of the French fry indicator? This is a brand new economic metric that I came up with this morning. Folks, in the 70s and 80s, there was something called the lipstick, uh, lipstick indicator, basically where people would go out and buy themselves just little treats to make them feel better. If you don't know about the economy in the 70s and 80s, it was horrible, horrible, horrible. And again, this indicator was just the sign that consumers were going out and buying just a little treat. So what is this French fry indicator? What does it mean? Is it something we have to pay attention to? I don't know. I'll share with you my thoughts and you let me know in the comments below. As you know, undoubtedly, French fries are one of those sides that is very common in the fast food industry. Obviously, when you supersize or family meal or all of these things, it comes with a main, a side, and a drink. It appears, according to the largest French fry manufacturer in the world, a company called Lamb Weston, French fry consumption has plummeted. In fact, it has plummeted so far that they are being forced to shut down one of their assembly lines, letting go of 400 individuals. Again, think about this. Now, think about why a large swath of the consumers are cutting back on French fries, cutting back at the same time with such force that it causes the manufacturer to close an entire production plant. I have come up with 3 reasons. Let me know in the comments below. 1, obviously inflation. I looked at a chart as I was putting this together that a median-sized French fry at McDonald's is up over 100%. Now that is wild to look at. So it just could be a cause that inflation for French fries has been too much, that they are finding alternatives, they're doing something else, right? Maybe there is AKA switching costs. If you don't know what that is, the greatest example is Costco. Costco actually puts out in their quarterly reviews something called people switching from beef to chicken. It's something they've talked about in the past. So maybe French fries are too expensive and people are switching to something else. Second, maybe with all of these Ozempic drugs and weight loss drugs and appetite suppressors, whatever it is, maybe the American consumers have just decided to stop eating fried food. I don't know. I guess that's an interesting take, but what about other fried foods? We haven't seen kind of a swath of consumption-based change on fried food. So maybe it's not that, but maybe. And then there is a third one. Quite simply, the consumers are stretched. Right? The consumers are stretched that they can no longer afford to supersize or get the value meal. They are being forced just to get a burger and a drink, something like that. In the end, I think this is a sign, unlike the lipstick, which was a little treat, this is a sign that the American consumer is really stretched, especially when you look at kind of the K-shaped consumer, something we've talked about for 3 or 4 years. When you look at the bottom end of the K-shape, right, asset renters, it really does feel like they are having to make some very tough calls. And this will have impacts on the economy going forward. So there you go, folks. The French fry economic indicator. Let me know what you think. What is going on? Why are consumers stepping back from French fry consumption in such great quantities at the same time? Well, let's talk about mortgage rates, mortgage applications, refis. Wednesday, we get the data. First and foremost, it looks like weekly mortgage demand dropped 9% week on week. You have to imagine, folks, the classic rates matter. We've seen a dramatic increase in rates, up over 60 basis points. So demand fell 9% week on week. However, it is up 159% year on year. A year ago, folks, rates were roughly 8%, a full point and a half higher. So yes, on a year-on-year basis, 159%. However, week on week, down 9%. If you want to break that apart with refis and all of that, purchase applications we're down 0.1%. So just basically flat, but down 0.1. Year on year, they were up 8%. Again, remember rates were 8% last year. And sorry about that. The number that I gave you earlier, 9% week on week and 159 year on year. Those are the refi. The total mortgage market fell 5.1%. So that's the total market, refi and purchase. What is going on with rates? Well, we've got some experts out making calls about 2024 and 2025. And all in all, I think these are kind of the numbers that I have put out on this channel. Fannie Mae thinks we will end 2024 at 6.2 and will end 2025 at 5.7. MBA is only slightly different, calling for 6.2 at the end of 2024 and 5.8 in 2025. As I have said for quite a while now, I believe rates by the end of 2025 will be 5.8. I see a lot of people calling, almost wishing for rates to continue falling. I just don't see that happening. I see stable rates being a key to fixing the broken housing market. So maybe mine is more wishful thinking, but I think we have another rough year if you are in the transaction business. Again, I think the mortgage industry has a little better than real estate because they have refis. As rates slowly come down, we will get some refi demand. I do want to shout out Logan from Housing Wire. There's also Resi Club, Lance Lambert. There's a lot of discussion about what is the magic interest rate to unlock the broken housing market. So there has been some calls out there, some theories that anything below 6% starts to unlock the move-up buyer. I think that is true, but not in the way that I think a lot of experts are talking about. From what I see is we get rates below 6 and maybe above 5.5. The unlock of marginal demand dwarfs marginal supply, and we have a problem, right? Demand greater than supply. I believe if you get rates below 5.5 to, let's call it 5, that will start to unlock more and more supply, but also more demand. I think the magic rate just to flood the market with supply is sub 5%. Logan does bring up an excellent point, which I fully agree with. We don't need rates doing this. We need rates doing this because, again, how do you fix a broken housing market? Time. It takes time. It takes time for life events, babies to be born, babies to grow, babies to raise, change jobs, get married, all of these things. It's going to take years. Again, folks, if you haven't done it already, go get my 54-year spreadsheet on my website, onerentalatatime.com. It is free. And look how long it took for the real estate market to become unbroken after the early 80s. It is eye-opening and shocking how long it can take to fix a broken housing market. I do want to shout out our school community. Yesterday, we did have a great hour discussion with PropStream. We talked about all things that you can do with data to find motivated sellers, lead stacking, all of that. In addition, I shared with you exactly how I am using it. I am using PropStream in Henderson, Nevada to find owners with greater than 50% equity listed on the MLS for greater than 45 days. Now, why am I doing that? Well, one of the reasons I'm doing that is I want to leverage the 90% CLTV, combined loan to value, that Stephen Dow has. So in order to have a seller possibly say yes, they have to have greater than 50% equity. Second, I am going to folks that have been listed on the market. Why? Because that means there's some motivation. And then 3, I want everything over 45 days. Now, on top of that, I'm looking for single family homes. I'm looking for non-HOA. and for reasonably sized lots, because the key to getting cash flow in Vegas, in my opinion, is the ability to add a casita or an ADU. If you don't know what we're talking about, folks, I did do a 6-part series on buying Vegas. And after looking at 6 different strategies, I think the way to get cash flow in Vegas, aka Henderson, is buying a single family home, adding an ADU, aka a casita. It is very hard to find cash flow here in Vegas. So I thought PropStream was great. It's already loaded on school. Just go to the classroom tab, go to the thumbnail that says special guest, scroll down through that amazing list of recordings, and it should be right there at the bottom. Also, I want to shout out Nicholas. Nicholas joined our school community yesterday. Nicholas, thank you for doing that. $20 a month, great education, amazing group. We want to be the #1 real estate investing school on the platform. Today, we are number 5. We have fallen off. We were number 3, then number 4. Now we are number 5. So we are going backwards. That is on me. Need to get more students, add more value, get more interactions. So that's what I will be trying to do. Also, remember, folks, you have an accountability group today by Frank. I'm actually wearing Frank's t-shirt. It says, I found my tribe. Thank you, buddy. Also, we have a bonus, Mitch. Mitch, I'm speaking at the NorCal RIA meeting today at 5 o'clock. Mitch was gracious enough to put a post inside school. So if you're a school member, you can join the Zoom for free, if I understood the statement. So again, go check that out. All right, what are some Fed presidents saying? Lots of Fed talk. We got to kind of cipher. Man, I think I have 4 or 5 of them. Let's go through them. Fed President Kugler. Support for further cuts if inflation continues to fall. Again, we've had these conversations with Mr. Dan Bird. The next 3 or 4 months, inflation is going to fall. It will get a little sticky and might reverse in April, May, June, but we will talk about that. The labor market is cooling. Don't want to drastically slow down the economy. If downside risk breaks, we will move quicker. How about Fed President Philip Jefferson? 50 basis point cut, armed and keeping job market strong. So why did they go 50? They want to help the job market. Fed President Lori Logan. Fed should not rush to neutral. That is interesting, right? So again, that's maybe not supporting a 50, maybe doing quarters, maybe every other meeting. We are really starting to see some disagreements in Fed presidents. Lower rates and looser financial conditions could reignite inflation, a la 1980s double dip, double top, whatever you call it. Not good. Fed President Alberto Mussolini, I butchered that. My bad. Will be appropriate for further cut rates over time towards neutral. Again, a lot of folks talking about neutral. The big question we're talking about is neutral 4% like Michelle Bowman or 3% like Neil Kashkari. That is going to be important as we get into next year. Do I have any more Fed? No, that's the last one. We have a financial expert out, Richard Bernstein, talking about Fed cutting rates when profits are expanding is not usual. In fact, he believes that in the next 3 to 6 months, people will say the Fed has cut too quickly. Again, this is something that we've warned in our conversations with Mr. Dan Bird. If you look at the how inflation is calculated, we're going to have a couple of months where inflation is going to appear to rise because of the base effect. Again, we have some large base effects here in the next few months, then relatively flat, which could be a problem. We could see CPI headline, CPI core rise simply because of the base effect. It will be very interesting. Lastly, we will give a shout out to New Zealand. New Zealand has continued rate cuts. In fact, New Zealand has their second jumbo cut, cutting rates by 50 basis points, folks. And the last thing, it looks like the DOJ is talking about breaking up big tech. It looks like big tech, meaning Google in this case, might be on the chopping block. The last breakup I remember was Ma Bell back in the day. I think it was AT&T. was broken up. Looks like the DOJ might be considering a breakup of Google for monopolistic behavior. Going to be fun to watch. That will definitely send shockwaves through the Silicon Valley, and it will be interesting to see where this goes. So, folks, again, remember, like, subscribe, comment. Thank you, man. 122 of you are live with me right now. We've been going for 15 minutes. I just want you to know that it means the world to me that you're here each day. I go live at 7:30, so you can join me live. I appreciate you. We do have 26 thumbs up. Not a great ratio. Love to see a ratio of more than 20%, but I like it. So thank you for being here. Join school. Sign up for the Vegas event. We'll talk to you soon. Later.